Have you ever wondered why you never seem to buy or sell at the exact price you see on your screen? Well, that very small difference, believe it or not, is costing you money every single trade. And over time, these costs actually build up. And to avoid these costs and avoid losing money, we need to learn about something called bid-ask spread. But alright, so let's begin here by answering the very important question: what are bid and ask prices? Well, in simple terms, a bid price is basically the highest price a buyer is willing to pay for an asset. And this asset can be, for example, crypto, it can be Forex, it can be stocks. And this is basically the price you would receive if you were to sell. And the ask price is the opposite. That is the lowest price a seller is willing to accept. And this is the price you would have to pay if you were to immediately buy. And if this sounds a little bit complicated, don't worry, it will be very clear soon. But first of all, we also need to understand the bid-ask spread. What is the bid-ask spread? Well, it's simply the difference between the ask price and the bid price. So if we use an equation here, you can see that the spread is the ask price minus the bid price. And here, I think, is when it will get clear for you guys, because here we have buy orders, which, remember, are the bids, and we have sell orders, which are the asks. So let's take a look at this step by step. Right here, we have the buy orders. Right here, we have the sell orders. And if we take a look at the buy side, we can see that first of all, we have someone or multiple people wanting to buy 500. Let's just think about this as a stock. They want to buy 500 stocks for 9.98. But on the sell side, we have 400 stocks. So the sellers want to sell 400 stocks for 10.02. You can also see the total value here of all the stocks. So now the spread here is basically the difference. So the difference between 10.02 and 9.98. So 10.02 minus 9.98. What is that? Well, that is basically 0.04 or 0.4%. And this spread we actually need to think about as a cost. Because let's say that we buy from the sell side for 10.02 and then we immediately sell it to the buyers, then we will actually lose $0.04 or 0.4%. That is very important. But alright, so now why does a spread even exist in the first place? Well, first of all, we need to notice that this is a supply and demand gap. Buyers want to always pay as little as possible. Sellers want to, get as much money as possible for what they sell. And this can create this gap. And by the way, guys, if you want to learn more about supply and demand, I do have a full supply and demand course right here on YouTube. So I highly recommend to check that one out after this video. Another thing that can create these gaps are something called market maker compensation. And that is basically that the spread provides profit for market makers who provide liquidity. This can be a bit complicated and a bit outside the scope of this video. But let me know down in the comments if you want to see a video on market makers. Last but not least, we have risk management. Wider spreads tend to occur during volatile periods. And this is periods where market makers, must basically protect themselves. So the more volatile a market is, the bigger the spread tend to be. And volatility is one of these concepts that is very important to understand and learn. And luckily, I do have a video about that. And I will make sure to link that video in the pinned up in the corner and the description. But now then, how does the bid-ask spread differ in different kinds of markets? Well, the size of the spread here actually varies greatly across different markets and different assets, and the primary reason here is due to something called liquidity. And once again, this is a very important concept, so I highly recommend to check out my video on liquidity. But just super quickly here, when it comes to stocks, popular stocks tend to have pretty low liquidity, you know, around 0.01%. As you can see, large, well-known companies usually have very tight spreads due to high trading volume. Same thing with Forex. Major Forex pairs tend to have very tight spread or low spread, and that is because the Forex market is extremely liquid, especially when you talk about the major pairs, like for example, Euro USD. By the way, if you want to learn more about Forex, I do have a video about that as well. Last but not least here, crypto has a very big difference when it comes to spreads. Large cryptocurrencies usually have pretty good spread, maybe 0.1%, sometimes even lower, while altcoins, especially if you're looking at very small altcoins, can actually have a very large spread. So just to show a very quick example here, by the way, right now I'm in Bybit. It's one of the largest crypto exchanges, and I actually do have a special link to Bybit that you can use to get, you know, more bonuses the more you trade. And you can actually get up to a total of $30,000 if you trade a lot here using that link. However, most traders will never even get close to 30,000. Most traders will get a $100 bonus, but it's still, you know, much better than nothing. So make sure to check out Bybit if you want to, if you are a crypto trader. But what I wanted to show you guys here is the spreads. So right now you can see up here in the corner, we're looking at Bitcoin measured in USDT. That is basically Bitcoin measured in dollars. But here you can see the ask side, these are the sellers, and you can also see the buy side. These are the buyers, and you can see that the spread here between the buyers and sellers are very tight, and you can see that the market is moving all the time. But let's actually choose a much smaller market here. So let's filter on volume, but let's filter on the least volume traded. So let's choose a very small altcoin. And what we can hopefully see here is that the spread will be much larger and the market will move much slower. You can see here we actually have, you know, more spread. You can see the spread here is the difference between the sell side and the buy side. So in this case, even though we have a small altcoin, the spread is currently, you know, relatively tight. But maybe if you need to buy a lot, so maybe you need to, you know, push up the price a lot to buy here, then the spread will of course be bigger. But now let's actually take a look at how different liquidity affects the spread. So here we have a calculator, and you can see that right now we are on a high liquidity market, but we can also choose a low liquidity market. And you can see that in the low liquidity market, the difference between the buy side and sell side, it's very far from each other, which leads to a spread, a pretty large spread of 1.30%. But when we choose the high liquidity market, you can see that the spread shrinks, and it shrinks all the way down to, in this case, 0.03. And this is very important because this is basically what we as traders have to pay. And if you are trading a lot in a low liquidity market, this will basically eat up your profits. So here is a summary of how liquidity affects spreads. In general, high liquidity, tight spreads. Low liquidity, wide spreads. How does volatility affect spreads? Well, during periods of uncertainty and high volatility, spreads will often widen here as market buyers will require more compensation for their risk. But right, so here I have a few more things that I do want to go over, but as I see right here, this video is getting long. So I think I will save the last part of this video for channel members. If you didn't know, we have an amazing community here on YouTube where I share presentations like this, I share trading tools, exclusive videos, and so on and so on. Right now, all the presentations like this will be available for gold and diamond member, but I think I will eventually roll them out to everyone. So if you want to get access to this presentation and also trading tools and other things as well, while at the same time supporting the channel, don't hesitate to become a channel member today. We would love to have you in the community. But alright guys, so now when you know about bid-ask spreads, you're ready to continue your trading journey. And to do that, I highly recommend to check out this playlist right here. It contains all the educational trading courses I have made so far, and more is coming soon.